European share markets are trading flat this morning, with the UK's FTSE 100 index and the US Stocks 50 index both up around about 3 points, while in the currency space the euro has lost a bit of steam against the dollar, but still firmly above that 130 level which it reached yesterday, and the dollar is stabilizing somewhat after plunging in yesterday's trading session. The yen has also risen quite sharply, but has stabilized since, and that's after Japanese equities fell overnight in the Asian trade. In peripheral bond markets, both Spanish and Italian bond yields are relatively calm. Good morning, I'm Ishaq, Siddiqi, and welcome to another daily market bite. It's Friday, it's the big payrolls day. I'm going to give you a quick idea of what's going on. As I said, it is US Nonfarm payrolls, the big jobs report that investors have been waiting for the past 2 weeks, ever since Fed Chairman Ben Bernanke gave his testimony and the Federal Reserve meeting minutes came out and suggested that the Federal Reserve are looking to taper quantitative easing. Now, since then, economic data from the US has been scrutinized quite heavily, and has been used as a gauge to somewhat second guess the Fed's next move when it comes to tapering or not tapering. That uncertainty has hit the markets over the past few weeks, and when it comes to the payrolls report, it is the most eagerly watched economic indicator from the US economy. If we see a positive number above 169, which is the expectations, 169,000, sorry, which is the current expectations for for jobs being created by the US economy in the month of May. If we see a number stronger than that, it would suggest that the Federal Reserve may look to taper quantitative easing in the coming months. However, a weaker number would suggest that the Fed may hold back as the US economy is still somewhat fragile. Now, this week we had a mix of US labor data. The ADP report, which is seen as a precursor to the payrolls report, fell short of expectations, but the weekly jobless claims, which came out yesterday, was pretty much in line with expectations, so leaving investors pretty uncertain about the outcomes today. So for that reason, we are seeing some volatility. Investors are holding back from making any dramatic moves and being involved in the markets too much, and staying on the sidelines until we get those big job numbers later on this afternoon. Now, when it comes to what's been going on in Europe, yesterday we had the Bank of England and European Central Bank policy meetings. Both central banks maintain policies at their current rate, so both the interest rates for the ECB and the Bank of England are at all-time lows of 0.5%. The BOE kept QE at £375 billion, while the ECB had a press conference, the monthly press conference, which follows the interest rate meeting, and it was somewhat underwhelming for investors. Markets expected a dovish chief Mario Draghi. However, he was a bit more hawkish this time around, quite unwilling to hint at the possible tools that the ECB have in their arsenal to stimulate the economy. Now, given the fact that the Eurozone economy is in pretty dire straits, the fact that we are in a recession and there's no bright spots to suggest that we're going to come out of a recession in the Eurozone anytime soon, investors were hoping that he would possibly suggest using tools such as buying asset-backed securities, maybe hinting at further interest rate cuts, or even the prospect of deposit rates getting into the negative territory. He said the ECB are technically ready for him, but did not suggest that the ECB will look to use negative deposit rates as a means to kickstart growth in the Eurozone economy. So the reception was underwhelming. On the whole, markets were disappointed that Mario Draghi showed a greater unwillingness to act to kickstart growth in the Eurozone. And since then, we've had a late rally on Wall Street in Thursday's trade. That set us up for a positive European session, but we also had a number of events in Japan this week. The Nikkei index fell sharply overnight, posting its third consecutive day of losses this week, and falling from its May 23rd peak. It's down around about 19.2% since then. Now, the news overnight was some chatter that Japan's government pension funds will look to increase their asset allocations to domestic stocks out of bonds. That helped the Nikkei rally off its session lows to end just lower, just about 0.2% down on the day. But investors were a little disappointed with the exposure that Japanese government pension funds took to increase equities increase domestic equities over Japanese bonds. Only raised them by 1%, so the overall asset allocation for domestic stocks was up to 12% from 11%. Not enough for investors to be too positive about Japan. Clearly, there's a lot of skepticism around Japan's Prime Minister Shinzo Abe's Abenomics policy framework. He shot his third arrow this week, which again was quite underwhelming and left a lot more questions about the prospects of Japanese economic growth. And investors do believe that at the moment it is quite uncertain as to where the Japanese economy is going. It seems like the stimulus effects from the Bank of Japan are starting to fade off. We are seeing a rise in the yen and a corresponding fall in Japanese equities, and this measured by the Japanese policymakers and the government pension funds to raise their asset allocations to domestic stocks is a way for them to address the decline in the Nikkei index over the past few sessions. Now, outside of all of this, we still have tensions flaring up in Turkey. Istanbul is very much in focus at the moment, and that's because the Prime Minister in Turkey, Mr. Erdogan, he stood quite defiant yesterday against the protests and the unrest in Turkey, and suggested that the government will continue with its plans to overhaul a park with a commercial building, which was one of the reasons why the protests were sparked in Turkey about a week ago. Now that threatens Turkey's economic case, as a flare-up of tensions and further violence could really undermine Turkey's economic prospects. It would essentially mean that Turkish stocks and the lira will be under pressure for some time, given it will raise a political uncertainty on the whole, and at the same time rating agencies may look to cut the rating of Turkey. So big focus on the Turkish market, and for the rest of the day we've got the Nonfarm payrolls, but back to some of the economic data out of the Eurozone. We have German industrial orders. Staying on Germany very briefly, the Bundesbank has cut its growth forecast for 2013 and 2014. It now sees GDP growth for 2013 coming in at 0.3% from 0.4% predicted back in December. And for 2014, it expects GDP in at 1.5% from 1.9% previously. So not a good turn, and equities on the back of that are trading on the flat line, particularly Germany's DAX, which is not doing much at all in reaction to that. So anyway, payrolls, big focus for today, and I'll discuss them on Monday's Daily Market Bite. Until then, have a good weekend, and thank you for watching.